There has been a lot of debate so far about whether a recession is coming or are we going to get a soft landing. But trust me, it is coming and it is not far away at all, because two major recession indicators that almost never miss have just both been triggered. So over the last 100 years, whenever, right, this yield curve flips positive, right, goes from zero to flip positive, zero to flip positive, we see this gray area. That's a recession. That's a recorded recession, even since 1929. But what's significant about this one is that now it's flipped as deep as 1929, and it's taken as long as 1929 to flip back into positive. Now, just quickly, the US 2-year and 10-year Treasury yields, they're meant to be in the positive territory because the 10-year yield is meant to be higher than the 2-year yield. But what's happened over the last 2 years is that it's gone the opposite way. 10-year is lower than 2-year yield, which is absolutely not normal, because you should make more yields, not less yields, when you lend money to somebody for longer. So the reason why this time everyone's been saying no, it's going to be a soft landing, and recession is not coming, whilst people like me are saying yes, the recession is still coming, is because we're all looking at these indicators saying, well, the indicator is going to trigger, which it has just done so last week, and that means recession is coming. But the problem is it took so long. It took 2 years for this recession signal to go into negative territory and then turn positive. We've never seen that in the last 1 century. The last time we saw this was in 1927, and this in itself means big trouble. You see, historically, the longer it takes the number of days to be inverted, right, more than 700 days, the bigger the recession or the crash in the stock market is, right? This is 1929, took over 700 days to invert, right, to come back to positive again, and the market crashed 90%. Of course, there's only been like about 10 or so recessions or even depressions in the last century or so, so it's not a large sample pool, statistically speaking, that we can look at, right? So bear that in mind. And another major indicator, right, that everyone looks at on Wall Street is called the sum rule. The sum rule created by Claudia Sum. Basically, they use unemployment rate, the rising unemployment rate, right, as a measure. And every time you see it when it triggers, right, it leads to this gray area, which is a documented, verifiable recession. And now we finally see Sum's rule ticking above again, making a move, right? Recession looks like it's coming. The sum rule officially triggers when it is above 0.5, and now it is at 0.57, officially triggering the sum rule of recession. However, the Fed is panicking right now about how recession is coming, right? Because both indicators, the sum rule of recession and the US 2-year, 10-year yield inversion, have both triggered. These are all huge signals that recession is coming. So the Fed has to do something about it. Well, one thing is they're going to cut rates by 25 points, even possibly 50 points. Right? I hope they don't cut 50, because if they cut 50 points, it signals they're panicking.
This is no joke, because look at the past. Whenever the Fed cut rates, right, markets tend to crash. And when they did that cut in 2000, we see the market top. This is S&P 500, right? And once again, when they cut in 2006-ish area, again, the market topped, right? S&P 500.
But the other thing they can do is make the data look good and tell people that there's nothing to panic about, that recession is not coming. And what they do is they get Claudia Sum, the lady who created the sum rule herself, the creator, to come out in the media and say, this time could be different. This time could be different. You hear what I'm saying? Get her, the creator of sum rule herself, to say that her recession indicator is wrong this time. But it is not different this time, right? Chances are we have major 2 signals just kicked off, a recession signal. Chances are a recession is coming, and it's a big one, like we saw, kind of like 1929, possibly, right? Possibly. And it's just taken longer than before, because the yield curve inversion has taken longer than before, right, to turn positive. And that's actually a bad sign, because that means the coming recession could be real bad.
But in terms of the market, stock market and the Bitcoin crypto market, I think there is one more pump left before the market realizes recession is seriously here, right? One more blow off top, right? So I think the Bitcoin can break into new all-time highs, get possibly somewhere near 91 to as high as 94, 95K before it tops for this cycle and turns down, right? Stocks such as NASDAQ and the Russell 2000 have one more leg up into new all-time highs to go. And But personally, I am looking out for this recession because we have those two major signals just being triggered. So I am looking to eventually exit both the Bitcoin crypto market and the stock market in the coming next few months. That could be 3 months, could be 6 months, could be 9 months, because nothing is 100% in this game. We need to watch it carefully now, and try to exit right near the top on the next big pump. And that could take 3 months or 6 months or even 9 months, right? Nothing is for certain. So if you want to know when I'm getting out, how I am timing this, how to dollar cost average out, then follow me because I'll be updating this constantly.